In the fall of 2022, over 60% of economists surveyed by Wall Street Journal predicted that a recession is coming soon. Now, 1.5 years later, the recession still hasn't arrived yet, and the recession probability figure has dropped from 60% to 39%. Of course, the Fed is attempting a soft landing.
A soft or softish landing?
It's a soft landing, with inflation coming down and unemployment holding steady.
But has the Fed really created a perfect soft landing? Meaning the recession is canceled. Or is the recession still an inevitable outcome? Finance first, freedom follows. Welcome back to Finc Freedom. Let's dive into this topic. Part 1. What is a recession? When we talk about a recession, what exactly do we mean? In simple terms, a recession is a significant decline in economic activity, spreading across sectors and lasting more than a few months. It's officially recognized when GDP, or gross domestic product, falls for 2 consecutive quarters. But it's more than just numbers. It's about real impacts on jobs, incomes, and lives. This decline manifests in various ways, most notably through job losses, a dip in consumer spending, and a general air of economic uncertainty. It's a domino effect. As people tighten their belts and spend less, businesses see a drop in profits, which often leads to workforce reductions. And when jobs are hard to come by, consumer spending shrinks even further, creating a downward spiral. Think back to the 2008 global financial crisis, a period marked by massive job losses, home foreclosures, and economic turmoil, or the more recent COVID-19 pandemic, which led to an unprecedented economic downturn worldwide. These events remind us of how fragile economies can be and how vital it is to stay informed and prepared. But remember, every recession is unique in its causes, impacts, and duration. Some are short and relatively mild, while others, like the Great Depression, are severe and long-lasting. Understanding these patterns helps us better prepare for future economic downturns. Part 2. Arguments for recession being canceled. Fast forward to 2024. The economic landscape has been a roller coaster, to say the least. After a period of uncertainty, we're now seeing some intriguing developments. Optimism in the economic sphere isn't unfounded. Here are a few reasons fueling this belief. First, let's look at the consumer sentiment. The University of Michigan's Consumer Sentiment Index has indicated that when people most fear the recession is coming, the index hits the record low of 50 in 2022. As time passes, people feel better about the economy, and they are willing to spend more. Now the index has climbed up back to about 70. On the employment side, there are 9 million job positions that are not filled as of December 2023, based on U.S. Bureau of Labor Statistics. The unemployment rate is 3.7%, laying slightly above the historical low, with headlines of tech companies laying off thousands of employees every single day. There seems not much to have been felt in our strong labor market. The corporate America is not doing bad either. In Q3 last year, total corporate profits grew 3.3% to an annualized rate of $3.28 trillion. That's just shy of the all-time peak of $3 trillion reached in Q3 2022. The stock market has reflected these great earnings. NASDAQ, SP 500, and Dow Jones all hit all-time high in Feb 2024. It feels like another buy-the-dipper frenzy, just like 2021. NVIDIA, dubbed the new Tesla, jumped from $110 to almost $700 in 16 months. If you didn't double your stock portfolio in 2023, you seem to have missed out. Another major way this cycle is often set off, especially when the Fed raises interest rates, is the housing market. But this one is different. Normally, when the Fed raises rates, that increases mortgage rates, which slows the number of new houses sold, slowing construction and furnishing and all the spending and jobs that come from a robust housing market. And usually a recession follows, but that's not really happening now. The number of new houses being sold has slowed, but it was already slowing thanks to a really limited supply. And what happened here? More than 90% of all homeowners have a rate below 6%. More than 60% have a rate below 4%. It caused a mortgage winter where people were literally locked in place because they couldn't afford to now buy a house at a higher interest rate and much higher prices. As a result, U.S. home price has stayed relatively strong. Part 3. Arguments for recession is coming inevitably. In the world of economics, there's always another side to the story. Despite the positive signs, there are valid reasons to remain cautious about declaring the recession canceled. Here's a reason many people may not have considered. In the recent years, corporate America has been so used to zero or artificial low interest rate on their debts. But this time, since the Fed has kept the interest rate high for so long, they will see a dramatic increase of interest expense, which is about 40% higher than they are servicing now. Most of these corporate debts will mature in first quarter of 2025. But for accounting purposes, if the company's liability debt is 12 months or less, it's reclassified as a current liability and their financials are impacted. Corporate America has never had this moment of truth. As we speak, this is happening this March. Thus, we can expect lower earnings per share across the board. This is one of the major reasons that so many companies are laying off employees just to make sure their balance sheets continue to look good. This being said, starting from March 2024, each earnings season is worth extra attentions. On the other hand, even though current unemployment rate is still very low, but the trend is ticking up. There are more than 100,000 workers at US-based tech companies have been laid off in 2023. In 2024, tech companies continue to lay off more employees. In the first 4 weeks of this year, nearly 100 tech companies, including Meta, Amazon, Microsoft, Google, TikTok, Block, and PayPal, have collectively laid off about 25,000 employees. The layoff is accelerating. On top of that, there is a herding effect in tech. Tech companies are the ones who control all the most recent data and analysis, and they are the first one who know which way the economy is turning to. The non-tech companies are following the tech, but may not have hit the headline. General Motors is laying off 35,000 workers. Ford 8,000, GE 7,200, Disney 7,000, Coca-Cola 6,000, 3M 6,000, KPMG 5,000, Walmart 2,000. Who else knows the economy the best? Banks. In 2023 alone, Wells Fargo has closed 258 branches, JP Morgan Chase 165, and Bank of America near 100. Overall, the number of bank branches in the US has shrunk by more than 1/5 to just 78,000 today. Just like the tech companies, these decisions are very collective. And it seems this effort has been contributed across the board. I'm not sure how well the economy is really doing, but I know these decisions are made by Wall Street elites, corporate America leaders, and tech giants. If I'm betting my own money on it, I'd rather follow them rather than the media. Lastly, US is experiencing a crazy consumption period. Finding a dinner table on Thursday night becomes difficult. If you are traveling, it gets worse. You will see the airports are full. There are long lines in front of car rentals and restaurants. Once you step out of the airports, each attraction sites have a long line as well. Disney World has become a luxury. Food prices are doubled, but nothing can stop US consumers. Is consumer spending really that strong? In 2023, holiday sales in the United States experienced a significant increase, growing 3.8% over the previous year to a record-setting $964.4 billion. This growth exceeded the National Retail Federation's forecast, despite the challenges posed by continued inflation and high interest rates. The overall sales for the year also grew by 3.6% over 2022, reaching a new high of $5.13 trillion. I agree these sales numbers are great if, here is the big if, credit card debt and delinquent rate are consistent. However, this is not the case. U.S. consumers accumulated $116 billion credit card debt in the year of 2022. In the first 3 quarters of 2023, total credit card debt is $138 billion, which is more than the whole year of 2022. This hasn't included the holiday quarter, which historically is the biggest consumer spending quarter. In addition, the delinquency rate on credit card loan has surpassed the pre-pandemic level, climbing back to 5.78%. Based on New York Fed, besides the recent resumed student loan debts, all other debt categories have seen uptrends on delinquency rates. Student loan payments restarted in October 2023, and that only adds onto the already burdensome household finance to many Americans. Many have argued the excessive savings Americans accumulated during the pandemic have been keeping the crazy consumption behavior afloat. However, that has come to an end. According to the San Francisco Fed, the excess savings went down $200 billion from September to Dec 2023. With this speed, these excess savings will drain out in Feb or March this year. After that, we may see a rapid increase in credit card delinquent rate. Overall, under the surface of strong consumptions, there are significant risks. The crazy holiday season shopping may simple because US consumers haven't learned how to tighten their belts for so long. Once used to spending easy money like the corporate America does, it's hard to turn back. Part 4. Impact on personal finance. In times like these, when the economic landscape feels like a shifting puzzle, what does it mean for your wallet? Let's talk about safeguarding your financial future in an uncertain economy. The cornerstone of financial stability is an emergency fund. Think of it as your financial shock absorber, softening the impact of any unexpected expenses or job loss. How much should you save? Aim for an amount that covers several months of living expenses. Now let's touch on investments. The key here is not to put all your eggs in one basket. Diversify. A mix of stocks, bonds, and other assets can help you navigate the ups and downs of the market. Debt, especially high-interest debt like that from credit cards, can quickly derail your finances. Tackling this head-on frees up more of your income for saving and investing. Speaking of investing, remember it's a marathon, not a sprint. Despite market fluctuations, maintaining a long-term perspective is crucial. Regular, disciplined investing can pay off over time. Budgeting might not sound exciting, but it's your financial roadmap. It helps you see where your money is going, making it easier to adjust and stay on track toward your goals. Finally, knowledge is power. Keep investing in yourself. Stay informed about financial news and trends. Understanding the broader economic context can help you make smarter financial decisions. By focusing on these areas, you can build a financial foundation that's strong enough to weather economic uncertainties. In summary, it's about building resilience and being prepared for whatever the economy throws our way. Stay informed, stay disciplined, and keep your financial goals in sight. To wrap up, the question of whether the 2024 recession is canceled remains open. We've seen signs of both resilience and risk in the economy. The most important takeaway? Stay informed, adaptable, and proactive in managing your finances. By preparing for both good and challenging times, you can navigate whatever the economy throws your way. And that's it for today's video. If you found this information helpful, please give us a like and subscribe to Finc Freedom for more financial insights. Don't forget to hit the bell icon to get notified about our latest videos. Keep working towards your financial goals and be kind to the others. See you in our next video.